What if I told you that three events, happening almost simultaneously, could reshape the global economy, trigger an energy crisis, and redefine geopolitical power? The United Arab Emirates leaving OPEC, an escalating Iran war threatening global oil supply, and rising tensions in the United States, Iran nuclear conflict. Individually, each of these developments is powerful enough to shake markets and influence global decisions. But when they begin to overlap, their impact multiplies, creating ripple effects that extend far beyond the Middle East. Oil prices don't just affect governments or corporations. They influence transportation costs, food prices, inflation, and even job markets. A disruption in supply can quickly turn into a chain reaction that touches nearly every aspect of daily life. This isn't just another geopolitical story. This is a perfect storm, and it's already affecting fuel prices, global markets, and possibly your future. Welcome to the Strategic Lens, where we break down complex global events in a clear insights. Today, we'll uncover why the UAE's decision is shaking the oil world, how the Iran war is disrupting energy flows, and why rising nuclear tensions could escalate into a global crisis. Let's begin. For decades, OPEC has controlled global oil prices by managing production levels. Think of it as a supply control system. When oil supply is reduced, prices go up. When supply increases, prices fall. This coordinated approach has allowed member countries to stabilize revenues, avoid extreme price crashes, and maintain a certain level of predictability in global energy markets. It has also given OPEC significant geopolitical influence, as decisions made within the group can ripple across economies worldwide. Now imagine one of its key members, the United Arab Emirates, deciding to walk away. Why? Because OPEC imposes production quotas. These quotas are designed to prevent oversupply, but they also limit how much each country can produce, even if they have the capacity to pump more oil. The UAE wants freedom to produce more oil, expand its market share, and maximize revenue. It has invested heavily in modern infrastructure and advanced extraction technologies, allowing it to increase output efficiently. From a UAE's perspective, staying within strict limits means leaving potential profits on the table. But here's the problem. When a major producer leaves a coordinated system, the entire system becomes unstable. Other countries may start questioning their own commitments. Some might increase production to stay competitive, while others may struggle to maintain balance. This move weakens OPEC's ability to control prices, maintain stability, respond to crises. Without unity, OPEC risks losing its influence over global oil markets, leading to increased volatility and uncertainty. And that brings us to the second, and far more dangerous factor. At the heart of this crisis lies Iran. The ongoing conflict involving Iran has triggered one of the biggest risks to global energy supply in decades. Why? Because of a narrow waterway called the Strait of Hormuz. This passage handles nearly 20% of the world's oil trade. But it's not just about numbers. This route is a lifeline for major economies across Asia, Europe, and beyond. Countries like China, Japan, South Korea, and India rely heavily on oil shipments passing through this narrow corridor every single day. Now imagine tankers being delayed, shipping routes under threat, military presence, increasing insurance costs for shipments, skyrocketing, global shipping companies rerouting or halting operations. Even a partial disruption here sends shockwaves across global markets. Oil prices spike. Stock markets react. Currencies fluctuate. Investor confidence drops. Inflation rises. And countries like India, which depend heavily on oil imports, feel the pressure immediately. Fuel prices go up. Transportation costs rise. Manufacturing becomes more expensive. Food prices increase due to higher logistics costs. And eventually, everything becomes more expensive. This isn't just about oil. It's about the entire global economy. When energy prices rise, manufacturing becomes expensive, supply chains slow down, food prices increase, transportation costs surge, affecting everything from daily commuting to global trade. Businesses face shrinking profit margins, leading to layoffs or reduced investments. We could be heading towards something economists fear deeply: stagflation, a combination of slow growth and high inflation. In such a scenario, central banks face a difficult dilemma. Raising interest rates can control inflation, but it also slows economic growth even further. Lowering rates might boost growth, but risks making inflation worse. Emerging economies are especially vulnerable. Higher import bills, weaker currencies, rising public pressure. Governments may be forced to increase subsidies or cut spending elsewhere, straining already tight budgets. Foreign investors may pull out, causing further instability in financial markets. And this is where things get even more dangerous. The conflict is not just military, it's nuclear. Tensions between the United States and Iran over nuclear capabilities are intensifying. On one side, diplomatic negotiations. On the other, military readiness. This dual-track approach creates extreme uncertainty. Behind the scenes, intelligence agencies are closely monitoring uranium enrichment levels, missile development, and potential covert operations. Any sudden escalation, whether through a miscalculation, cyber attack, or proxy conflict, could rapidly spiral out of control. If diplomacy fails, the consequences could include regional war expansion, complete closure of the Strait of Hormuz, oil prices skyrocketing beyond control, disruption of global trade routes, increased military involvement from major world powers. At that point, this stops being a regional issue and becomes a global crisis. Let's step back and look at the bigger picture. What we're witnessing is not just a crisis, it's a transition. A shift from controlled energy markets to fragmented systems, stable alliances to multipolar tensions, economic predictability to geopolitical uncertainty. But this transition goes even deeper. Countries are no longer willing to operate under rigid collective frameworks if it limits their national ambitions. Energy is no longer just a commodity. It's a strategic weapon, a bargaining tool, and a symbol of sovereignty. The UAE leaving OPEC is not an isolated decision. It's a signal that global energy power structures are changing. And when power structures change, new alliances form, old ones weaken, and competition intensifies. Nations begin to prioritize self-interest over collective stability, which can lead to more unpredictable outcomes. We are entering an era where energy decisions will be driven less by cooperation and more by strategic advantage. And that shift could redefine not just oil markets, but the balance of global power itself. Three forces. One outcome: a fragile world standing at the edge of energy instability. These developments are not isolated headlines. They are deeply interconnected shifts that ripple across economies, politics, and everyday life. From rising fuel prices to supply chain disruptions, the effects are already beginning to surface in subtle but significant ways. The question is not whether this will impact us. The question is, how far will it go? If you want more deep, strategic insights like this, subscribe to the Strategic Lens. Because in today's world, understanding geopolitics is no longer optional. It's essential to staying informed, making smarter decisions, and seeing the bigger picture behind global events. From energy crises to shifting alliances, we break down complex issues into clear, actionable insights, so you're never left guessing what's really happening. Stay ahead, stay informed,